The U.S. economy saw its national debt climb above $38 trillion recently. But what may be even more concerning is the fact that it just passed 37 trillion 2 months prior. Part of that is higher interest rates. You have the higher interest payments tied to those. It all means that we're racking up more and more debt at double the pace we saw at the beginning of the century. Now, the bigger question: how can the problem be addressed and chart a new course, like starting to reduce the debt? Kent Smetters is a professor of business economics and public policy at the Wharton School. He is also faculty director of the Penn Wharton Budget Model. Hi, Kent. How are you?
Good to be back. Thank you.
$38 trillion question right now. How do you address it?
Yeah, 8 trillion of that 38 is kind of the government, owing itself. And so what we call the debt held by the public, that did also hit a new high around $30 trillion. And so, we are approaching almost World War II levels of debt relative to the size of the economy, which peaked in 1946. But the difference relative to World War II is that every projection given the current fiscal path has the debt GDP ratio going up even more. Whereas after World War II, it was, a very punctuated spending, and now spending went way down, and therefore the debt GDP ratio also fell quite a bit.
Where can you cut? I mean, obviously, there are a lot of public programs that are very important that you really can't do a whole lot with. But where can you cut to try and maybe start to make an impact?
Right. I mean, there's a couple of facts. It's not just potentially cutting, you could also potentially even get more revenue. So let's actually talk first about the revenue side. So two facts are important here. One, it is true that the United States has some of the lowest revenue relative to GDP amongst the OECD countries. But it's also true that the United States has by far the most progressive income tax system relative to the OECD. And so those on the left, will often emphasize the first point, but then forget the second point. And, conservatives will often emphasize the second and forget the first. And I think it's one of those things that's about balance. And that is, you can only get so much out of a progressive income tax system. And unless you go broad-based taxes like in Europe or value-added tax, things like that, it's really hard to get more revenue. We're always squeezing that lemon pretty tight. In terms of the spending side, big drivers are things like growth of entitlement programs. Now, on one hand, we knew that was coming and we didn't save enough for that. On the other hand, a lot of money can be achieved in terms of cost saving eventually by simply continuing to increase the retirement age, the normal retirement age at least, over time. And it doesn't have to be done immediately. We're talking about maybe for people under age, 50, instead of the retirement age being 67, it's going to be 67 in a couple months, and then gradually increase with life expectancy over time. And so it's really that the fact that it's not just that we're going to have a lot more retirees going into retirement, is that they are continuing to live longer, and we don't have that adjustment in both the healthcare program and in Social Security. So a combination of some revenue now, and then some cost savings in the long run, it can put us on a sustainable path. It just requires both parties are very far away from anything that's they're talking anything related to
Yeah.
sustainability, but there are options.
Well, yeah, in the midst of a government shutdown right now, they've got a few other things that they're worried about.
Sure.
There is, though, some urgency, especially on the Social Security point of it. If you go by a lot of the estimates that have been out there the last few years, that the issues of Social Security are going to come to a head in about a decade, maybe even less.
Yeah. Even less. It's probably about 8 years or so. The Congressional Budget Office and the Social Security Administration, we're basically around the same date, and we're like kind of the three groups that are doing independent estimation of that. And so I think that's definitely true. And unfortunately, the last time the Social Security Trust Fund was about to deplete of its assets, we waited till kind of the last minute to make changes, and that was really unfortunate. Hopefully, we get a little bit better at it now. But nonetheless, it's one of those things that I think what you're starting to see is some very populist measures that people are proposing right now. There seems to be this myth that if we in fact just go after the companies and have the companies pay more, because Social Security taxes are split between workers and companies, that somehow that's better than just having workers contribute more. In fact, economists agree from both the left like Joe Stiglitz to the right like Harvey Rosen. They both have textbooks in public economics. It turns out it doesn't really matter which side that you tax, whether it's workers or companies. The net impact of who really pays and is going to all be adjusted in the form of wages. And as a result of that, it doesn't really matter which side that you tax. It doesn't mean that one's going to bear more than the other. It just means it doesn't really matter. So we have to get away from some of these populist things and really do serious analysis of what's the economic impact.
Well, and then the revenue from tariffs that we've seen the Trump administration tout recently, realistically, is that kind of a short-term benefit? Because I think I don't know what the expectation is of what tariffs will be down the road. Obviously, the administration wants to try and build more businesses here in the U.S., which I guess is the hope that that will help kind of build the tax base and will help to alleviate some of those issues on the debt. But that's a long process to begin with.
Yeah, I mean, the more immediate concern that sometimes people have is the actual tariff revenue itself. So this is going, of course, before the Supreme Court, who will release their decision likely at some point in December. And that is the emergency powers that Trump used during the second term. Will that, in fact, be, upheld or not? And so if, in fact, the court says no, that the president did not have those powers to enact tariffs, then the government will lose about $2.8 trillion over the next 10 years. Having said that, though, tariffs are an extremely inefficient way of raising revenue. They are, in fact, the least
Right.
efficient way of raising revenue. So it would actually be pro-growth, even though we'll lose that revenue that could otherwise be used to paying down some debt. It would actually be pro-growth just to get rid of the tariffs. Really realize is that 40% of all imports into the United States is not is just for helping businesses actually produce more efficiently.
Right.
And so the fact of the matter is we don't want a John Deere and so forth in making their own screws and metal sheets and so forth. We want them to focus on the really high margin stuff and get the cheap stuff, and diverting resources to making our own screws is super inefficient. And so there really is a lot of harm gets caused by the tariffs, but also it makes capital markets even more contracted and smaller. And we're trying to sell more and more debt over time, so that makes that a little bit harder.
How then do you deliver the message to the public at large of where we kind of stand with this debt issue right now, and maybe how they can understand it better, so we can have a path, we can figure out a path down the road?
Yeah. So there's really kind of three barriers that we've identified at Wharton Budget Model of why people don't seem to be that concerned with it. The first is, people way overestimating the potential impact of AI and really misunderstanding its impact on the fiscal system. I think you and I have talked about this in the past. People can go to our website and see that AI is not going to generate that much deficit reduction. But the second issue is that people are saying, why aren't things going bad in, interest rates and financial markets and so forth, not realizing that mortgage rates and everything else are actually much higher than they otherwise would be, because we actually have a lot of capital per person right now because of everybody going into retirement. We really should have pre-COVID levels of interest rates and mortgage rates right now. So we're a couple hundred, maybe 150 to 200 basis points higher than where we really should be. And that's all going to get worse over time as baby boomers eat away some of their capital. But the third real reason is that there have been some really irresponsible groups out there who are pretending to have numbers and doing analysis. They're just hacking things away. And they've been being the boy who cries wolf for a long time. And, the sky hasn't fallen. And so,
Yeah,
therefore, maybe this isn't such a big deal. It's kind of the Al Gore effect. We're not underwater right now. You know, they, all the, icebergs haven't melted. So, therefore,
yeah.
the environment must not be that important. And so, of course, that's all kind of fallacious, but nonetheless, the boy who cries wolf has really been very damaging. And so what we really need and what we're trying to do here is put things into context and really do serious analysis that's a lot more convincing than just trying to get media citations and bribing reporters to cover us.
Kent, great to talk to you as always. Thanks very much, sir. All the best.
Thank you.
Kent,
Appreciate it.
you got it. Kent Smetters, professor of business economics and public policy here at the Wharton School.